What's going on, guys? Thanks for joining me. Today's video, I want to change up the format a little tiny bit. I want to start by giving you guys a portfolio update, kind of my recent thoughts, do a little bit of benchmarking, and then I want to move on to the news that I'm following as an investor of over $52,000. So hopefully you guys get some value out of this, and let's get right into it. So I guess the first update I want to give you guys is the fact that right now, I'm actually pretty satisfied with how this portfolio is both performing and how it's set up. So if you've been following the channel, you know that it's composed of 6 different ETFs, and it's organized into 3 categories: value, growth, and the S&P 500. Within each category, if I go into growth, I have one plain equity ETF and then one hybrid covered call fund. In this case, it's VGT, BST, and if I back out and go to my dividend slice, I have the same exact format. Now, even though I'm very happy with what I have, I'm always looking to potentially simplify it, improve it in some way or another. So I've been backtesting different portfolios to not just see the overall performance, but also how they behave, right? The different characteristics of these setups. So for example, this top one is only 5 ETFs, so a little bit more simple than what I have right now. And this one's even more simple, 4 holdings. And I gotta say, based off of the limited data I've been looking at, this very simple 4 ETF portfolio in the red line has some really compelling performance overall across different market cycles. So let me know in the comments, do you guys think this more simplified version of my portfolio is better? Like I said, I'm very happy with what I have right now, so I'm not in any rush to change, but I'm always keeping my options open. When it comes to what I have right now, over the past week, we have gains of 1.53%. We're all enjoying gains right now. The market has been very strong. Over the past 1 month, this portfolio is up 6.21%, and in the past 1 quarter, 11.65%. If we compare that against the S&P 500, which is my benchmark, over the past week, this is up a similar 1.32%. The past 1 month, a little bit less, 5.4%, and the past quarter, a little bit more at 12.57%. So we're essentially right in line with the benchmark. I like to see that. But we are generating more realized gains along the way in the form of dividends. And really quick, before moving on to the news and headlines that I'm paying attention to as an investor, I want to pose another pretty major portfolio question to you guys. So you guys know this is my main portfolio. I show it on the channel all the time. But in addition to this, I have a Roth IRA that has a pretty substantial $21,656 in it. This portfolio follows the same exact logic, strategy as my main portfolio, but it's a bit more simplified. I just have these 3 ETFs. The conundrum I have here is that I haven't contributed to this portfolio in years, and that's because I plan on retiring off of my main taxable account well before I'm 59.5 years old. We all know that tax advantage accounts like this have real advantages over taxable accounts, but again, because I plan on retiring well before 59.5, I've been contemplating whether or not I should sell out, close this account, and transfer the funds to my main portfolio. There is a 10% penalty for doing that on my gains. And the benefits are, 1, it will consolidate my positions, because again, this is the account I'm going to retire off of, hopefully pretty young. And the second advantage is actually for this little side business, this YouTube channel. Having this number be 72,000 instead of 52,000 might help this channel to get a bigger audience and generate more income that way. So let me know in the comments, is that a dumb idea, or should I consolidate my positions if I'm not ever going to utilize that account? Moving on to the news that I'm paying attention to as an investor, as a diligent investor, the number 1 news today, of course, is the May CPI report. And this was really positive news for the stock market and the overall economy. This is the chart of the historical inflation rate, and the latest reading in May 2023 was 4%. Still double the 2% target of the Fed, but it's well off the high of, I think it was 9.1%, and it continues the strong downward trend. And the big immediate impact this CPI report has is going to be on the Fed's decision in just 1 day to pause or continue to raise rates. And as you would expect, this cooler inflation bolsters the argument for a Fed rate pause. So that meeting is in 22 hours, and this is where the current probability stands. 94% chance of a pause and just a 5% chance at this point of another 25 basis point rate increase. Just before this latest CPI report, the probability was more like 25-75. So this latest report and that nice 4% inflation rate is giving a lot of investors confidence right now. And that's at least one of the reasons why today the S&P is up another 0.6% on top of the sustained rally we've been going through. Okay, so inflation is heading in the right direction. We do have to wait and see how sticky the remainder is going to be in the journey down to 2%. I'm optimistic it's not going to be overly sticky because if you guys remember, one of the major causes of inflation was the supply chain shortages. Coming off of the pandemic, everything was in short supply from toilet paper to computer chips. But ask yourself this question: when was the last time you saw a headline talking about shortages? It kind of solved itself in the background. If you guys Google supply chain shortages, all of the results that come back are going to be pretty old, most of them coming from 2021. To give you guys a more specific data point here, the chip shortage was one of the worst shortages of all, and that really peaked in 2022. Yes, it is true that some chips might still be in short supply, but it's not a chronic issue across the board anymore. If you want to pick up a PS5, you can do so now. But if you still need convincing, egg inflation is below 0%. If you guys remember, just a couple of months ago, there was so much news coverage on the skyrocketing inflation of egg prices. But this is another one of those categories that quietly in the background, the supply chain has fixed itself. And I think the fact that we're seeing supply chain issues go away is going to be another tailwind for fighting inflation. Another topic I'm keeping a close eye on is the recession people keep predicting, or at the very least an earnings recession in the S&P 500. The argument here is that because of the high prices, people are spending less, and thus the earnings for companies is going to have a dip in the near future. So using this report, we can take a look at the actual data on this topic. So this chart is the revenues per share of the S&P 500. So if I zoom in a little bit here, we can see that in 2020, during the pandemic, there was a sharp decrease in revenue. That was followed by a very strong bounce back due to the stimulus, unemployment money, causing rampant inflation, supply chain shortages. But to this day, we're not seeing a massive correction or pullback in the revenue of companies. Now this chart might be a little bit more useful because it is the earnings per share. So again, we see that pullback during COVID, followed by a sharp rebound, a spike in demand, followed by a cool-off period. And I don't know about you guys, but when I look at this chart, it seems like now we are just reverting back to the mean, which is a pretty healthy spot to be. This parabolic growth we saw in 2021 was certainly not sustainable. But again, since then, we've cooled down to essentially back to the mean. And I'm not seeing any significant downward trend here. I find this chart very useful. So this is the positive and negative surprises of revenues for companies. And right now, most companies are surprising to the upside rather than the downside. And here we have the same chart, but for earnings, and it's even more compelling of an image. You can make the argument that there is a slight downward trend beginning to form, but you can also make the argument that it's beginning to flatten out, and this could be the soft landing the Fed is trying to perform. I am seeing more and more companies like Morgan Stanley publishing research that they are now believing that a soft landing for the US economy is more likely, but they do warn that any kind of turbulence in the future could threaten this. So that's an update on my portfolio, where it stands, how I'm feeling about it, and the economic data that I'm paying attention to right now. I hope you guys enjoyed. Thanks for watching, and I'll see you guys in the next one.